the more I talked about real estate, everybody else also aspired to own real estate. They just either didn't want to admit it or they didn't know where to get started. And the moment I started to explain to them that they could invest passively by partnering with, an expert like us, more and more people started raising their hands. And when I realized there was a whole market for this, right, and I started, getting some of my own mentors who said, you're really kind of running a boutique private equity firm. You can really take this to the next level.
Hey, welcome back to the Massive Passive Cash Flow Podcast. I'm Gary Wilson, your host. I'm so glad to have you back listening to the show or watching if that's the case, which you can do on YouTube and Facebook and a number of other channels. But we got an excellent guest today, Kristopher Morin from beautiful Connecticut. We were just talking about that. I've got family right over the river, right over the Sound on Long Island, a little area called Conscience Bay, close to the ferry that crosses over. I've got some family there and in-laws on the other side, and caught in Connecticut, a beautiful place. If anybody listening, if you've never been there, I'm a huge traveler. Connecticut is one of the places you want to visit. It's very diverse. You've got water, you've got hills, you got farms, you've got great cities and towns. I mean, it's just an awesome place. But enough of that, Chris. If you could, Chris, first off, I just want to say thank you for being here. And if you wouldn't mind, maybe fill people in a little bit about your background, because like me, you and neither one of us started out doing what we're doing today. We came from another part of our life, and sometimes it's good to have that context because it makes sense to people to resonate with people who are in the same boat you and I were, you know?
That's right. So thank you, Gary, for having me on the show. Really excited to be here. And you're right. I think we all start something different, at least most of us. There's some pain that we feel in our lives that drives us to go discover, the solution, right? For me, that was corporate burnout. I think that probably resonates with a lot of folks. When I got started in real estate, if I were to rewind for context for the viewers, I'm 42 now. It's 2024. I was a young middle 20s executive or rising executive at Accenture, a big consulting firm. By all means, I was kind of living the dream. Strong six-figure income, traveling all over the country, working in some of the biggest clients in the world. And I kind of had there. I always say there were two sort of converging forces that kind of came together right around 2009, and that date should be a clue to one of them. And that was, I started burning out early. I was like, I was on a plane 49, 50 weeks out of the year, and I realized, that wasn't sustainable. I couldn't imagine working that hard for, I don't know, name it another 30 plus years if I truly, 'cause I had this aspiration of retiring wealthy and, I had under palm trees, all the
Mm-hmm.
stuff that young guys want, the wealth. But I realized that it wasn't sustainable. I couldn't save my way to retirement. I certainly couldn't slave away for the next 30 years. I was just burning out and I was miserable. And then, the Great Recession hit, and I watched a lot of people who, some of them could have been months away from retiring, have half their net worth ripped out from underneath them. And, while stocks always recover, I couldn't imagine, right,
Mm-hmm.
working that hard if I managed to get there and then all of a sudden, boom, I'm forced in the workforce another 5 or 10 years because some event that's outside of my control. So it was really those two things that forced me to stop and say, I need to prepare differently, think differently about how I prepare for retirement, invest. And, like anybody, I started with Google, started doing some research, how do the wealthy preserve and grow their wealth? The breadcrumbs are out there. All I have to do is pick them up. And of course, real estate rose to the top as a common theme, private equity being another one. And so I said, whether I like it or not, I have to go figure out this real estate game. Lucky for me, it turned into, I call it a raging passion. But initially, it was
Mm-hmm.
just, I'm going to build security, add additional income streams. And, I guess I'll fast forward a little bit, over the better part of the last decade, 14-ish years, I did build a very successful career. I ended up becoming an executive, held executive roles in multiple companies, most recently director of strategy for a $5 billion line of business in Connecticut, while
Mm-hmm.
simultaneously growing this real estate company that, eventually became, a real estate private equity firm, Three Peaks Capital, where we're investing in larger commercial assets in key markets around the US, because it really became a point in time where I realized the more I talked about real estate, everybody else also aspired to own real estate. They just either didn't want to admit it or they didn't know where to get started. And the moment I started to explain to them that they could invest passively by partnering with, an expert like us, more and more people started raising their hands. And when I realized there was a whole market for this, right, and I started, getting some of my own mentors who said, you're really kind of running a boutique private equity firm. You can really take this to the next level. That's exactly what I did. And so eventually, I took a severance package. I was kind of there was a restructuring at one of my most recent job, gave me the opportunity to take a severance and really just focus on the growth of Three Peaks Capital. So, I left a lot of details out, but that's kind of the 50,000 foot
Yeah.
of what's gotten me to where I am today.
Yeah. Well, it definitely resonates with me too. I was 40 years old and I basically saluted the bank I was at for the prior 18 years and said, guys, I just don't need to work anymore. No offense, it's been a great journey, but I'm going independent now, and I'm going to live off my real estate. And some of them knew what I was doing, but most of them did. They were blown away. Well, you really find out when you do that kind of stuff who your friends are, because I was shocked at some of the responses from people, some pleasantly and some very unpleasantly that I thought were my friends. And a lot of it's just jealousy. They were like, wait a minute, you're 40 years old and you don't have to work anymore, and here I am 60 and I'm still slaving away. And I'm like, it's please don't blame me. I mean, we all choose our own journeys, but this is the journey I chose. You chose your journey. I'm happy to help you and show you what I've done. But in any case, the bottom line is I never look back, and it sounds like you haven't either. So for me, what I got started in was the small multifamily, literally duplexes, triplexes, fourplexes, and eventually moved into the bigger.
Right.
I made a huge jump from my largest holding was an 11 unit building, and the next one was a 90 unit building, and I thought I was really like questioning, am I losing? Is this real? Like that kind of questioning. And it absolutely was. And we doubled the value of that building and doubled the rents coming in like an 8 year period. Of course, we thought it was going to be 3 years. Yeah, yeah, but it took more like eight. But tell me about your journey. I understand you also were really into the multifamily too. Was that your launching pad into real estate, or tell us about that a little bit, you know?
Yeah, so I'll color in between the lines a little bit there. I really started out in the single family flipping space. It's
Yeah.
kind of it's what the gurus tell you to do, right? So I was kind of doing what I was told, go out there, flip some houses and make some money and buy multifamily. And I did that really from 2009 to 2015. And, lucky for me, timing, right? It was a great time to do that. Lots of supply, lots of foreclosures, lots of opportunity to go out and make really good money. And I was a traveling business consultant. So, I had projects going in Connecticut. And yeah, I kind of had this light bulb moment where I say, I get on a plane, I go to Detroit on Mondays for 4 or 5 days, and then I come home the next weekend. I'm there every week. Why don't I build a team in Detroit, right? So I find some realtors, build a team, start flipping houses. Next thing I know, I'm Richmond, Virginia. And, every
Yeah.
location that I went, I just started forming new teams. And we did that for about 5 years pretty successfully. And I was leveraging the business operations acumen that I was building as a consultant, just applying it to my own business to really mitigate risk and improve profits. And so it was going really well. But that was burning me out too. And so I had this revelation. It was really around 2015. Once again, the burnout theme. Anybody who flips houses, especially at scale, I always used to say I'm a glorified babysitter of contractors. It's
Hmm.
a lot of work. It's a day job. You're a marketer, you're a salesman, you're a project manager, you're all these things. And like a job, the moment you stop, the income stops too. And I remember getting off the phone. There was one particular project that was giving me, a whole lot of heartache back in Connecticut.
Hmm.
I was in actually Richmond at the time in a hotel. And I remember thinking, that's it, I'm done. Like, this isn't passive income. This isn't why I got into real estate. And so I let all
Right.
the projects finish out. I took, close to a year off because I was just burned out. And that's when I came back and started buying multifamily. And I wish I did it sooner. I tell everybody now, listen, just start with multifamily because they think it's higher risk. And I'm like, actually, flipping single family houses, there couldn't be possibly be any more risk than that, right? Everything you're doing is as guesswork.
Hmm.
I'm going to buy it at this price, but I think I'm going to fix it under this budget on this timeline. I'm going to sell it for this price. It's all speculation, right? And something always goes wrong. There's always scope creep. So if you don't have capital reserves on hand, you're taking a lot of risk. So,
Hmm.
I know I'm preaching to the choir, but that's really when I jumped into multifamily. And like you said, I started with twos and threes or the occasional six or 10, whatever presented itself.
Hmm.
And I just very quickly, through either acquiring them myself or joint ventures, lots of different types of partnerships, built a portfolio to well over 100 units that I was self-managing, which gave me
Hmm.
lots of great experience before, to your point, kind of transitioning into the larger assets. And I think for you and I'm going to probably speak for you as well. I would imagine it gives you a competitive advantage to some of our peers in the industry who, they could be very smart business folks just like us who step into this space, but they launch right into 100 or 150 units. And that's where I draw the line a little bit, because
Yeah.
if you've never managed assets yourselves, how can you go in and manage that scale, especially when you're using millions of dollars of people's money? You don't know where the landmines are. You don't really know what to watch for. And
Right.
so as you're problem solving, it's more reactive, like, oh shit, that happened. Now we have to fix it, as opposed to, you know, how to anticipate and just prevent, right? And so I found that I was really competitive. Our projects did really well out of the gate. And that was the driving force that gave me the motivation to just continue down that path.
Yeah. Did you know that you can participate in class every Monday? We call it Monday Night Live, 7 p.m. Eastern, with me and dozens of other investor agents from around the country, in fact, the world. Every Monday, totally free. No selling, no recruiting, just straight up education on anything and everything in real estate. And we have a lot of good guests coming on once or twice a month, bringing in expertise on subjects like how to buy a house with crypto. Okay. How about them apples? What about AI? How's AI affecting our business? How about the metaverse, blockchain processing? We're already using it in title work. So come on to Monday Night Live. Be ready to take notes and ask questions, because it's live and engaging, and you get to participate by asking questions and meeting others. So we'll see you there. Go to realestateWithGaryWilson.com, click on the resource tab, drop down, and you'll see Monday Night Live. And in there, you can see one of the most recent classes. But more importantly, you can register for class as many as you want going up to like the end of the year, I believe. So in any case, do that. We'll see you on Monday Night Live. Look forward to meeting you in person. Take care. Well, I'll tell you what, first off, I really appreciate you sharing that part of your story, Kris, because I know for me, part of it was luck. My freshman year of college roommate, we became best friends. And when we graduated, his dad, we were just going to go rent a place at the beach. This was in Tidewater, Virginia. We went to Old Dominion University. And his dad said, "No, you're not going to rent. You're gonna own a home." And we're like, "Okay, sure." So, but he was a big investor in Richmond, by the way. He lived in Hopewell, Virginia, which is just south of Richmond, and he had 150 some odd units there while he was working at Fort Lee as an engineer. So he showed us how to structure the deal. This was January '86, very creatively. We assumed the guy's first mortgage. It was a VA mortgage. We refinanced the second. We gave him a third note for the remaining equity. And we still cash flow. We rented out the other 2 bedrooms to 2 other guys, and their rents pretty much paid our monthly outlay. It was crazy. But in any case, I think I had a distinct advantage here. And admittedly, I'm glad to say that that's the truth. I wasn't born to do this, I don't think. But what happened was, when I was 35 years old, I'm sitting there thinking, I wish I'd have done more what Mr. Demet taught me to do, because he told us, he said, if you boys do what I tell you to do, you won't have to work for anybody else when you're 35 years old. Well, I didn't listen. I got married, had kids, and all that stuff. Did the corporate gig. 35, I started investing, and I did retire 5 years later. But I started with the rentals. And that's when I started getting information from all these gurus teaching all this stuff. And you're right, they were teaching flipping, flip first and then buy rentals. But here's what I found out, Kris. This is what I'm driving at. I was teaching people how to buy rentals locally. And the people that had started off buying flips almost never succeeded. They never stuck with it. They burned out. They would flip one and have success, and they're thinking, geez, this is so easy. And then they take too many risks and they've collapsed. But the people that did the rentals first always stayed around the longest. They had the longest staying power. They had more cash flow. So if you make a mistake in a flip, it could knock you out completely. But if you make a mistake in a rental, you have to evict the tenant, or you have to remodel the unit. It's very forgiving as an asset goes, and you can improve it. You can add on. There's so many things you can do, and you have this income producing asset that you can borrow against eventually. And that's exactly what I did. So you mentioning that was my story, and I want to tell people, it's not just me. It's not just Kris, guys. I know fun flipping looks like it's more fun. All the television show, there's no television show on, hey, buy this rental. Probably more people do that. But sometimes it's the boring work, the hard work, that gives you the most money over time, wealth and income. So, in any case, try to ramble on about that, Kris. You just really hit a very important subject for me that I try to preach myself. But going forward, so did you get into the business of raising capital too, like Three Peaks
Yeah.
Capital? Is that what that's about? Or take us through that journey too, if you don't mind.
Yeah, sure. So locally, I had this company. It was Equivest Group, and it owned a flipping arm and a multifamily arm that was Equivest Properties, and then Equivest Management. So I had all this tiered organization. That was Kris's company locally. that I manage here in Connecticut. And so yeah, I started out by raising capital. Even in the beginning, I got to a point where I had my own capital.
Hmm.
But I always wanted to raise it really for two reasons. One, I wanted to keep cash on hand for emergencies and for other opportunities, right? Especially as your portfolio scales, and you probably know this, it's really easy to go, hey, where did $50,000 go, right? A roof, a furnace, this and that. You need
Hmm.
capital reserves on hand. But I also wanted to give new investors an opportunity to taste blood, so they would want more. And I would say, hey, listen, come in on this project. It's a great one for all these reasons, blah, blah, blah. Because I knew new investors, even if they started out small at the time, 25,000, once I showed them how easy it was, they'd come back to 50, 100, or bring their friends the next time. So, I had to raise capital in the beginning to continue to buy at scale. Otherwise, my money would have dried up anyways, right? And then it was an opportunity to just kind of, like I said, let people test the waters. Three Peaks Capital was born really just about, right around 5 years ago now, right around 2020, just before COVID hit. I decided, I'm going to set up a new team and we're going to go focus on Midwest markets. Now we're targeting 50, 100 units plus at a time. And so I set up a new structure and a new team to do that. We went out and bought, a couple different assets, 50, 60 units at a time out across Indiana. Very good economics reasons for why we did that. But Three Peaks Capital was set up separately to drive that initiative. And then, that entity is raising capital at a much larger scale because, under the Equivest group where I'm buying stuff here in Connecticut, again, I'm still just gobbling up 4 or 6 units. I'm only raising $100,000, in total at a time versus now we're raising 2, 3, 4 million at a clip under Three Peaks Capital. And we work with both accredited and non-accredited investors, so we're open to both. We have a fund. We structure our deals in lots of different ways, but that's kind of the quick overview on Three Peaks Capital there. Yeah.
Cool. Well, hey, if you wouldn't mind, let's go to um, let's have like a classroom type setting, and if you could walk people through the process of acquiring the asset, managing the asset, because I want people to hear this, that there really is a method to this, and the more um, if you have your goal, you have your plans, and you execute, you have your checklist. Just like when a pilot goes into the cockpit of an airplane, they don't just turn the key and go. They go with a complete checklist, man. And that's
Yeah.
why we have such a success rate in the airline business. But is there something like that you're doing also when it comes to acquiring and managing the property, so you can kind of take us through the process there?
Yeah, sure. So, I kind of drawing from my career as an executive in strategy, mergers and acquisitions, I always kind of used to say I'm kind of a glorified economist. And so,
Hmm.
I place heavy, heavy value on really understanding the macro and micro level economics of the markets that we're choosing to invest in. So I mentioned a moment ago that, Indiana was a target for us for a very specific reason. At the time, everybody was starting to target the Sun Belt, Dallas, Florida, all the way through to
Hmm.
Arizona for real good reason, lots of movement there, right? But there's far too many investors, whether that's on the LP side or the GP side, who think, population growth alone makes it a good market. And that's not true. So I went and started pulling the data that nobody else was really looking at the time that has now flipped deals upside down, and that is supply. I had investors call me and say, hey, call me, Kris, call me when you get something in Dallas. And I said, listen, I'm not going to invest there. Have you seen the tidal wave of new units coming, right? And then, by if you're willing, let me check that business plan you're going to invest in, John
Yeah.
Doe. Let me just like share my thoughts. So I had a lot of investors come to me with these plans that were projecting 8, 10% year over year rent growth. And I knew it just wasn't plausible, right? So they would say things like, well, the average median income in the area is much higher. That's true, but the cost of living is higher too. So all things being equal, their wallet is just as stretched as any other consumer wallet, even in a more affordable, lower income area of Indiana, right? But the cost of living in Indiana is much lower. So those rent
Mhm.
bumps are actually more sustainable, right? So you start to look at the
Right.
economics differently. So I'm going to end up going down my economics rat hole, but you can get the sense that, I do have an economic checklist. I'm very comprehensive view into the markets that we're investing in. I look for both short-term risk, long-term risk, and short and long-term opportunity. Because when we build a footprint, we really want to have a strong long-term foothold there. So yeah, a part of my checklist is a very comprehensive economic analysis. We look at a lot of variables that our peers in the industry just, I think, fail to recognize. It's allowed us to drive a lot of profit, and then, like you said, from there, once we've solidified a market, then we get boots on the ground and we start to look at all the nooks and crannies. Don't invest in that block, invest over there. We talk to local
Mhm.
chambers of commerce, development councils to see, where's the future developments coming in, so we know where those pockets of growth are going to be. Because instead of jumping on like the Dallas train where, you're kind of at the top of the curve, we're getting into the markets where we know we're going to be at the bottom of the curve and we're going to ride that wave up. So there's again, I'm kind of repeating myself, but there's a whole process in and of itself just to say we're going to invest in Indiana, very specifically Fort Wayne, Indiana, very specifically in the north part of the city, and here's all the reasons why. And then of course we look for the assets that are going to allow us to drive the greatest amount of value, whether that's through increased rents, rehabilitating the property, and we try to get in at a good cost basis. And we've always been focused on putting fixed rate long-term debt on our properties. I think a lot of
Mhm.
people were using bridge debt. You got some better terms in some cases, but we always use debt that sometimes diluted returns a little bit. So I used to say to investors, we're never going to be the highest and best, but I'll bet my last dollar we're always going to be the safest. And at the end of the day, what we're showing you for our projections is exactly what you're going to get.
Yeah.
And so, yeah, we would take the assets under contract, start the due diligence. We would start educating investors early on. This deal is coming. Here's what we like about it. We ultimately, when we finish our due diligence, then we would finish our investor overview documentation. We'd hold a webinar. I'd have individual presentations with some investors who wanted one-on-one phone time, but we would review everything from that market
Mhm.
assessment to the deal. Here's why the deal wasn't performing yesterday. Here's why we believe it's going to perform tomorrow. Here's all the actions we're going to take to get it there. Here's the risks in the deal, right? And how we're going to overcome it. Here's the amount
Mhm.
of time that's going to take. And then ultimately, we're going to sell or refinance, in year 3, 5, 7, or whatever,
Yeah.
and get you your money back. And so I probably drew that out a little bit, but I wanted to kind of put emphasis like, it is a simple process at the end of the day, but done
Mhm.
right, there's a lot of complexity if you were to pull back the curtain, but it's all stuff the investor doesn't really have to worry about. You just got to
Yeah.
make sure you're partnering with the right team who's doing that stuff.
Yeah. Well, so it's interesting, fact of life that the more simple something looks to the cat to the observer, usually it's because the practitioner is making it look simple because they're so good at what they do. They're so detail oriented, and a lot of the
Right.
skills and talents that you've developed in your professional life and in the corporate world. Same thing for me. I mean, working at NASA, working in banking, working for the U.S. Navy, tracking. Well, I guess I can tell people tracking Soviet subs is what I did. All that detail level of analysis and checklists and things done in a certain sequence in a certain order you know lent itself well to me when it came to investing. To me, it was easy because it's not only real estate, it's not only an asset, it's an income producing asset. And the inventory, it's like a business, any business. The inventory is your property. The clients your customers are your a month. You've got third party vendors, you've got municipal people, utility people, lawyers, accountants, inspectors, appraisers. I mean, all these people you're dealing with. Um, but it all fits a pattern. You do develop an instinct too. I mean, just like Robert Kiyosaki teaches you, you learn to read the financial statements and the stories that they tell. I know when I buy a big asset anymore, I always tell people I don't want just a rent roll. I want a certified rent roll. So I make the owner certify that the rent roll is true and accurate. And I don't even buy anything if I don't get the portions of their tax returns that I need to see what they've been reporting. I don't need to see how wealthy they are. I just want to see that asset, how it's being reported. If they won't show it to me, that's the indicator they're trying to hide something, and I just move on. I just don't take the risk. Don't take the risk, folks. So in any case, so what you're doing right, if you're listening and you're, an engineer, a teacher, a pilot, you know, I promise you the skills that you've learned and developed are applicable to this business. And Kris mentioned Indiana. I love Indiana because it's not just Indianapolis. There's two other great towns like Fort Wayne and Lafayette. Both are great towns. They're tertiary towns. Nobody pays attention to them. But like you said, the cost of living is so much lower. The rents are sustainable and they're usually higher relative to cost basis than areas like Chicago and New York and LA and San Francisco. I'm not against those areas. There's different strategies we use there, but I love I still love like South Carolina, Tennessee. Everybody knows about Tennessee now, and Alabama. All these really paying attention in. I'm like, these are great areas. You can pick up properties for a lot less money. The rents, you've got a lot of room to grow, and they're stable. By the way, any other areas geographically you can think of, if, as long as you don't mind sharing some of your secret sauce, other areas like
Yeah.
Buffalo, for example. Look what Buffalo did in the last generation. Just amazing. And it's not
Mhm.
a Sunbelt city. It's cold,
Yeah.
but
Yeah.
it's turned around. So
Yep, yep. And Buffalo's rent is among the highest in terms of rent growth. Yep, for the last couple of months, even now as we talk in September 2024.
mm,
Yeah, so I think the Midwest, there are headwinds that I think are or tailwinds, I'm sorry, that are going to continue to benefit the Midwest rental markets, I think, for the foreseeable future. And that's really because of the limited supply that is there relative to the demand. And just
yeah.
to close the loop on the Dallas comments I was making earlier, that tidal wave of supply that came on now, now landlords are dropping rents because they're trying to compete for the same tenants because there's so many units to choose from, and eventually they'll absorb. But for a period of time, those business plans that were accounting for 8, 10, 12% rent growth, now they're only getting 3 or 0, which has been happening for nearly two quarters straight. So Midwest, Kansas City, Indiana, like you said, Indianapolis, Lafayette, Fort Wayne. I think Boise is still great.
Yep.
Utah's got some great markets. I'm a big fan of Seattle, and a lot of people would say, "Oh, that's a blue state." Well, you know what? It's one of the great growth markets of America. There's no denying that. Blue states come with some of the regulatory hurdles, but you just have to underwrite it a little bit differently, right? You factor different risks into
Yep.
your business plan. I wouldn't let that prevent you from investing there. When you think about what's happening at a global level right now from a
Mm-hmm.
technology advancements, AI, right? Um,
Mm-hmm.
Most of that tech is being, developed and led from Seattle, right? And it's going to remain one of the great growth markets, I think, for the foreseeable future, at least the next decade. Seattle has kind of reached its capacity in terms of being built out, and so now that expansion is happening northward and outward, and there's a couple of pockets that outside of Seattle that I think are going to really benefit long term, and so. I'm also a big fan of the Northeast, Connecticut, Massachusetts in particular, all the suburbs surrounding Boston.
Mm-hmm.
Very strong markets underpinned with biotechnology, absolutely recession resistant. Huge demand, especially as the boomers continue to age out and advanced medical care and technologies become
Mm-hmm.
more and more important long term. You have all those companies driving that innovation in the Northeast. So
Mm-hmm.
I guess just a couple of tidbits there.
Yeah. There's a great town. If you have to pronounce it correctly, it's Worcester. It's really spelled
Yeah.
Worcester like it's Worcester, and they'll know you've been there before. But great town for investing. I've got a couple of students there, and I've been there before teaching multiple times. And there's so many of those around the country. And you're right when you mentioned Washington. For everybody listening, if we use a term called green states, and it really goes beyond the politics, blue and red. And I personally, I'll just admit, I don't invest in California. It's too blue. I mean, it's just they're so anti-business, and I know I'm going to take heat for saying this, but it's just true. They're tough on business owners. They will, if you're a resident, they will tax you no matter where you are in the world. Any income you make from anywhere, it's global income taxation, like the U.S. federal
Wow.
government is. It's the only state that does that. But regardless, what I'm getting is Oregon and Washington are both green states. People are moving in. There's lots of beautiful areas there. Just a beautiful place to be. So the green states aren't always going to be Texas and Florida and Georgia and the ones you always hear about. Pay attention to the other states. I mean, that like Arkansas is another one that's looming large now. Oklahoma, Arkansas, Alabama, I mentioned. They're mostly more temperate climate wise, but also business wise, they're also very favorable. They're good for business owners. So, hey, I know we're going to run a timer pretty quickly, and I could come up with a million more questions, but one of the big ones is like I came from the corporate world. I had the big 401k, and I did my own investing too in the stock market. Did well. Again, just using it simple analysis tools and just making the best. I would eliminate the downside risk, focus on upside potential, and make those decisions. Well, it's not always right, but I was right a lot more than I was wrong. But in any case, back to the real estate. I mean, if how does real estate like offer resilience against economic downturns, market volatility, unlike what something you might get in the stock market? It's like you have no control. It's going to go up and down, and all you can do is watch it. So,
goes up and down, and certainly have to give credit that it always comes back, right? So that we'd
mhm,
be remiss if we didn't acknowledge that. But even, I think it's the earning potential that you can achieve even during a downturn, right? So I think people ask me all
mhm,
the time, well, what if you buy that multifamily and values drop out from underneath you? And I say, okay, if it happens, it doesn't happen all the time, right? But if it does, I don't care. I don't feel
mhm,
it. And they kind of look at me like, what do you mean? Because if whether it's 10 unit, whether it's 10 tenants or 100 tenants, those 10 or 100 tenants, they're still going to pay me every single month, right? In
mhm.
fact, in most cases, even during a recession, rents continue to go up. So I'm actually going to be
Mhm.
making more money. I don't really care what's happening to the equity because, like stocks, it always comes back and then some. It's always kind of followed by a surge. So cash is king. We're going to continue to produce profits even when perhaps stocks are just not, right? And so for me, that's always a big one. And ultimately, I remind folks, when you're buying commercial real estate, you got to think of it more as in terms of buying a business. And so anytime that
Mhm.
my rents are going up, my profit margins are going up, the value of that business is essentially going up. And so that creates a really strong buffer against, any, if there is an expansion in cap rates, right, it creates a buffer against that. And so you might see a little bit of a drop in demand, but you have a more profitable asset. And so for me, multifamily is just a dependable, safe, reliable investment.
Yeah, I agree 100%. It's always going to go up in value over time, gradually steady. It's the tortoise, not the hare. The rents go up, but over time, all of a sudden you realize, my gosh, you've got all this equity, you got all this cash flow. That's a great position to be in. So I know we're running out of time real quick, but I had one more question, Chris. I want to go back to our beginning when you and I both for our careers, but for everybody out there listening right now and watching, what advice can you give to the professionals who are really getting to the point of like, man, I gotta get out of here. I can't do this corporate grind anymore. I can't sit in a cube anymore. I want to be outdoors. What anything you can suggest them to help them break free and maybe do sort of a little bit of what you and I did?
Yeah, I think the most important question that people have to wrestle with, and keep in mind that real estate, I believe it's a get rich blueprint for anybody, but it's a get rich slow. And so once you've digested that reality, I think it's important to ask yourself, am I prepared to be an active investor or a passive investor? Because active comes with a lot of responsibilities, right? And so if you've got kids and you coach their team, right, and you've got all these hobbies that consume a lot of your time,
Mhm.
the active route may not necessarily be for you, but the passive route can be just as powerful or better
Mhm.
depending on the types of investments you're investing in. So I think that's the first question that people have to get really honest about, because most people just race off and they try to become the active investor. And much like flipping houses, they realize, oh, this is too much work. This isn't for me, and they just
Mhm.
they just give up entirely, and then they don't even choose the passive. So that's really the first bit of guidance that I would say. And then you don't have to look for partners like us or people who are investing in the very best markets in the US. There's lots of people around you, and certainly I would love for you to invest in me, right? And sure,
Mhm.
I'm sure Gary would too. But every market can be a winning market. There are strategies that are winning everywhere, even local to you. I don't care where you are. And so all you
Mhm.
have to do is find a partner who understands what those strategies are and they understand how to exploit it. And you can do very
Yeah,
well in your own local markets as well.
I agree 100%. And I'll give everybody a big tip here. Join your local investor club. If you're not going to like everybody, but you like enough people, they'll take you under their wing. That's what I was lucky because of Mr. Demet, but also later on when I got serious about it, I went to a local apartment association meeting. This is where the property managers came and got together, but also the big owners were there. And I found the table that I call it the old lion table. These were guys in their 70s and 80s, and I thought they look safe. I was kind of a shy guy. I'm going to sit and just talk to those guys about golf and stuff. Sure enough, they took me under the wing, and one guy in particular, Gerhard Flugfelder, took me under his wing for the next year. And I would go around and help him move refrigerators and stuff and watch what he was doing in his 70s, by the way, you know, and he showed me how to actually get started, in a much bigger way. And I just can't emphasize enough. And I met him through that networking, partnering up with somebody who was already where I wanted to be. And that was a major, to this day, I'm so grateful for him and Mr. Demet. Um, and you couldn't put a price tag on those two educations. So everybody listening, keep in mind there are people out there like Kris who are willing to help you. I had people like Kris help me. If you got Kris helping you, you've got me helping you. So Kris, how can people get a hold of you? Website, contact information. What's the best thing we can do to help them reach out to you?
Sure. The best way to get me, I'm a big social media guy. I am a millennial after all. So you can
Hmm.
follow me on LinkedIn or Facebook. It's Kris with a K. Message me. Don't be shy. Ask me questions. I'm always there to help because, like you said, somebody else was there to help us. And so I'm always willing to give it forward. And if you're interested in potentially investing, then happy to always get on a call and answer questions about that as well. There's certainly never any pressure to take any action, but social media is a great place to start. If you want to view our company website, it's www.3 spelled out 3peakscap.com, and you can learn more about us there as well. There's lots of free giveaways about what we do.
Cool. So threepeakscap.com, all spelled out, everybody. And take Kris up on his offer. It's with a K, Kris, Morin, Morin. And look him up on social media, guys. Appreciate you listening to the podcast or watching if that's the case. If you, please leave a review. Kris and I both really appreciate your reviews. Your reviews is actually how our podcast will work. So a lot of people don't know that, but all you gotta do is get on the computer, 60 seconds, leave a review, and we certainly appreciate that. And we will see you on the next Massive Passive Cash Flow podcast. In the meantime, take care of yourselves, and God bless you and your loved ones.
Thanks for listening to this episode of Massive Passive Cash Flow. Be sure to go to realestatewithgarywilson.com to join our community and start building wealth today.